Hey everybody, and welcome back to Investing with Wesley. I'm sure almost all of you have thought about retirement, leaving work and never having to worry about money again, traveling and doing whatever you want, enjoying the freedom portions of your years. Now, what if I told you that you could actually enjoy that sooner rather than later? I'm sure that's something that everyone would be interested at least learning about. So in today's video, I want to talk about the 2 IRS rules that can make this dream a reality for you. Let's get into it. Okay, so let's assume that you've been working for many years, you've been saving, you've been investing, and you look at your retirement portfolio and it's large enough to where you can theoretically retire, but you're not at the age to where you're allowed to retire yet. You haven't reached age 59 and a half. What really can you do? Well, there's 2 IRS rules that allow you to take your money early from all sorts of retirement accounts without having to pay those penalty fees. Now, I don't mean loopholes like IRAs have where you're allowed to purchase a home and take money like that penalty free and those things. I don't mean loopholes. I mean there's actually words and rules written down that allow you to take your money early penalty free. The first one is the rule of 55. Now, this rule states that you're allowed to start taking your money from your retirement accounts once you reach the age of 55. Now, in order to qualify to use this rule, you have to meet some certain things. The first one is you have to have a separation letter from your employer at the age of 55 or later. And that separation letter can really be anything and everything. You could have been laid off, fired, or even just quit. It doesn't really matter how you separate from your service as long as you're separated from your service at the age of 55 or later. Now, the second thing you need to know is if your employer-sponsored plan even offers this rule or not. Just because the IRS says it's okay doesn't mean the 401k plan that you have with work allows you to do it. So contact your HR department and see if they even allow you to do it. Chances are these HR people have never even heard of this rule and they'll just approve it on a whim anyway. Now, the 2 bits of bad news about this rule is that it only affects employer-sponsored retirement programs, not IRAs. So IRAs are just not eligible for this whatsoever. Now, let's assume that you have money in an IRA, a 401k at a previous employer, and your 401k or 403b, whatever you decide to be at your current employer. Now, based on the rules, you're only allowed to take money from this current employer once you separate because now you've reached the age of 55. The employer you used to work for, you separated from them before the age of 55, so you technically can't use that money. But what you can do is roll over the assets in that 401k and your IRA into your 403b, 457b, or current 401k. And then when you separate from service, all the money that is now located in your current 401k is reachable with this rule of 55. Now, I want to stress 2 things here. The rule of 55 only grants you access to the money in your retirement accounts penalty free. If you have your money in a Roth account, don't think you're going to get your money tax free because the rule is it's tax free once you're at age 59 and a half or later. So if you wanted to take advantage of this rule to get your money in your hands that much quicker, just know whether it's traditional or Roth designated retirement account, you will be paying income taxes on all of your growth and non-taxed contributions. So just as a refresher, if you had a traditional account, the money you put in, your contributions are not taxed. So when you withdraw them, you'll be taxed on that as well. But if you had a Roth account that you were taking early, you'll have to pay taxes on your growth, not your contributions, because your contributions have already been taxed. Now, the second rule that allows for early withdrawals penalty free from retirement accounts is the rule of 72T. Now, the whole premise behind the rule of 72T is the SEPP program, or the Substantially Equal Periodic Payments program. Now, if you wanted to use the rule of 72T to take your money early, you'll have to make substantially equal periodic payments for 5 years or until you reach the age of 59 and a half, whatever happens later. So if you are age 56, then you would still have to do it for 5 years, even though halfway through you've reached 59 and a half. Or if you decide to do it much younger, like in your 30s, you would have to do it until you reach 59 and a half, even though that is way longer than 5 years. It is 5 years or age 59 and a half, whichever comes later. Now, the term substantially equal periodic payments can sound kind of confusing or scary to some people, but really all that means is equal payments taken at least once every year that do not change. If you pause these payments, change them in any way, you're going to have to pay all those penalties you've been avoiding. And because the IRS is greedy, they charge those penalties retroactively, meaning all the money that you withdrew prior to changing up this program is going to be subject to those penalties. So the most important part of the substantially equal payment is equal payment. Do not change them once they're set up. The good thing about the 72T rule is that it does work on IRAs and employer-sponsored retirement programs. So as the rule of 55 only let you take it from your current employer once you separate, this one is any retirement to include IRAs. Now let's talk about those substantially equal payments. Like I said, they have to come at least once a year, but you could take your money bi-weekly, monthly, whatever it may be, as long as it happens at least once a year and as long as the total amount taken annually never changes. Just like the rule of 55, you will still have to pay taxes whether it's traditional or Roth. And again, it's for the exact same reason. Even if it's in a Roth account, you didn't make it to the age of 59 and a half, so that money is not tax-free. Now, this is a retirement strategy, so you cannot pull money from any employer-sponsored retirement accounts that you currently still work for. You have to separate from service before you use the rule of 72T to take money from those accounts. Now, these rules can be a little confusing, especially when talking about the substantially equal payments. So I want to talk to you about calculating those payments. Now, there's plenty of online calculators that you can use, but they're going to ask you certain questions that you may not know the answers to. So those are the questions I want to cover in the remainder of this video. When calculating your SEP payments, you have to use a combination of IRS tables and methods. So let's talk about the tables. Now, I'm going to be reading to you right off of my notes because, let's be honest, it's just a mouthful. The uniform table covers unmarried account holders or married account holders with spouses less than 10 years apart whose spouses aren't the sole beneficiaries of the account. So the easy one is if you're unmarried, you fall into this category. If you are married and your spouse is within 10 years of age to you and they're not the sole beneficiary of your account, then you again would fall into this category. The next one is the joint and last survivor table. Now, this applies to spouses more than 10 years younger and who are sole beneficiary in the account. So if you have a spouse that is more than 10 years younger than you and who is the sole beneficiary, that would be the table that you would fall under. And lastly is the single life table. And this table is, as you would imagine, applied to the single life of an individual. But this isn't you, it is whoever the beneficiary is. It is tied to the beneficiary's life and no one else. Once you know what table you fall under, then you can go on to the method that you would like to use in calculating your SEP payments. Now, there's really three methods. There's the required minimum distribution method, the amortization method, and the annuitized method. But I have to say that if you really read what it says, the annuitized and the amortization method are basically the exact same. Now, when you run your calculations, you're going to see that the amortization method will give you a little bit more money per year, but I really mean only a little bit more. There's a difference of $100 or $200. So let's talk about the RMD method, the required minimum distributions. This method is basically if you wanted the lowest amount possible. So if you wanted to retire early, but you didn't really need a whole lot of money from these accounts, you just needed a little bit as like a supplemental to the cash flowing assets you may have, then you may think about taking the RMD method just to leave the majority of your retirement assets in your account to continue to grow. The RMD method is the lowest possible amount that you could take every year and still qualify under the rule of 72T. Now, both the amortization and the annuitized method are fixed, meaning you won't have to change them at all. But because the rule of 72T is what it is, you wouldn't really want to change them anyway. But both of them automatically lock in and never change for you. However, they both also use the federal midterm rate and the beneficiary's life expectancies to calculate the amount of money that you could possibly receive. Now, the better your money grows in the account, meaning the more interest you receive on average, the more money you're going to be allotted to get using the rule of 72T. Now, my favorite calculator when calculating the distributions for the rule of 72T is using the website Bankrate. They have a perfect calculator that's really easy to use. So just as an example to give you guys, I plugged some numbers into this so you could see what kind of money you'd be allowed to take each year. So I assumed I had $1 million in my retirement account that was getting on average of about 6% in interest. I also imagined that I was 45 years old and my beneficiary was 43 years old. The table I decided to choose to fall under was the single life table. So based on plugging all those numbers in and using the RMD method, I'd be able to take about $25,000 per year out of my retirement program. So plugging all those numbers and the tables I fall under into this calculator, it tells me that if I wanted to use the RMD method, the minimum distribution method, I'd be able to receive $25,000 per year early pre-retirement age. Using the amortization method, I'd be able to receive $66,000 per year early from my retirement account. And using the annuity method, it would be $65,800 and some change. So once again, the amortization and annuity method are very closely calculated together. I know the rule of 55 and the rule of 72T can be pretty confusing, especially if you don't understand anything about taxes, retirement, or finance whatsoever. But I hope I helped shed some light on this kind of difficult topic to talk about. And not only do I hope you got value from this video, but I hope you actually apply it and start saving, start investing so that you can also enjoy early retirement. Until our next episode, have a good one.